Now, accounts of insurance companies. See here, in case of insurance company, Mr. A can take a policy with the insurance company. Especially, I'll focus on life insurance policies. Hope you are able to see the screen, audio, video, everything is clear, right? For the online students, come on, text me. Yeah. For insurance company, A being one of the policy holders wants to start with take a policy. So with the insurance company, I assume LIC being one of the insurance companies. So A has paid premium for taking a policy. The policy value, otherwise named as sum assured, being 1 lakh. So the policy amount or sum assured being 1 lakh will be payable by way of premium over the life. Over the life of the policy is called term of the policy. In this illustration, we assume the term of the policy being 10. Then naturally, anything happens to A, then A will get, or A's legal heir will get compensation from LIC, usually policy amount, policy value, or sum assured. So for that, the consideration payable by A to the company being LIC company being premium on policy. Usually the premium on policy is calculated by dividing the policy value by term of the policy, maybe around 10,000 rupees. So anything happens to A will be compensated with a minimum guaranteed amount which is called 1 lakh. It's not a final amount, it's a minimum guarantee. There may be chances of getting more than that also depending upon the period expired after the taking the insurance policy. So 10,000 is payable. If suppose A demises or something happened bad for him, automatically as per the policy terms and conditions, LIC has to pay sum assured or policy amount. Sum assured or policy amount. Policy value. How much is that? 1 lakh should be payable. This is only happening the worst scenario. Is that clear? And of course, the connection between A and LIC is not directly happened, routed through some third party, maybe agent. So this connection between A and LIC, okay, linked because of agent. Because of this, LIC has to pay an agency commission, probably around 10% of the premium. Like so, 10,000 premium, 1,000 rupees may be premium payable by LIC to agent for getting the policy. So fourth, commission payable. This commission may be 1,000. I assumed it may be an assumed value. Clear? Policy value or sum assured, term, premium, and commission. For the revenue of 10,000 rupees for the LIC company, LIC has to pay commission immediately. Apart from that, on maturity or something happens for the A's life, and LIC has to pay another amount which is called sum assured. Is that clear? So one revenue, two expenses. One is immediate expenses, another one is commitment to meet whenever it arises. But in the case of LIC, if A pays 10,000 rupees every month, every year for 10 years, 1 lakh could have been paid. If A demises after that, then he gets what? 1 lakh rupees. Then A may demand, what happened, sir? I invested 1 lakh rupees, you are giving me 1 lakh back. Won't you give me some extra benefit? So definitely there will be extra benefit that will be called as bonus. Okay. So fifth point is all about bonus. In case of bonus, the LIC company may offer once in every 3 or 4 years. Okay. So while offering the bonus, LIC company may demand, would you like to take it in cash or would you like to reinvest this? So any bonus comes, it may be given immediately in the form of cash. Or the policyholder says, don't give me the bonus. Every year I have to pay the commission, no? Means premium, no. In that premium, just adjust this. Okay, that's how the bonus may be settled. Bonus in cash or bonus in reduction of premium. Or he simply says, sir, accumulate this bonus, I will get at the last. Okay, this is called reversionary bonus. Reversionary bonus. Is that okay? Reversionary bonus. So on maturity on nth period, A will get full value sum assured plus any bonus included in that without withdrawing during the period. Lump sum value will be paid. Especially in the case of life insurance, we have one more term called surrender value. See, the term may be 10 years. After payment of fourth or fifth premium, A feels it's not possible to pay the policy amount, premium month on month, year on year, whatever it may be. A demands, sir, I want to cancel and give me money back, whatever the amount available in my account. Usually that is called surrender value. It will be lesser than the amount deposited. So every year 10,000 rupees for the 5 years period, he might have deposited 50,000 rupees. If he wants to cancel it immediately, he will get only 40 or 42,000 rupees, less than what he invested. Plus any amount accumulated on that as a profit will also be added. That is called surrender value. So the amount payable, policy value is called claim. Claim may happen in case of LIC by death. Because of death of policyholder, the claim may be payable, or because of maturity. By the end of 10th year, A will get the money. So 3 categories of payments are there: claim by death, claim by maturity, or he wants to cancel his policy and gets the value immediately recovered, which is called surrender value. Hope you will be now able to understand all these things. This is what about the small background of the LIC company. In case of general insurance, we don't have the maturity value or surrender value. Only if accident happens, then you will get a claim. If I go for car insurance, okay. So once in every year, you have to pay the premium. If the car meets with no accident, not theft, then you will not get anything. Okay. Halfway through, you don't have the options to surrender. That's all. The amount you paid is, that's all. Anything worst happens, you'll get the claim. Otherwise, you don't get any claim. Hope you'll be now able to understand this one. Hope. Now, suppose you just think over, instead of the policyholder being A, it's a big corporate like TCS, Tata Consultancy Service, makes a payment of premium to LIC like 10,000 lakhs, just to convert this, for all their employees. And LIC has to pay, anything happens to employees of LIC commonly, maybe again you add 1 lakh lakhs, otherwise 1,000 crores. The policy value may be 1,000 crores and premium is also very big money, and commission payable on this being 1,000 lakhs, otherwise 10 crores. Is that okay? That's the scenario. In this case, something happened worst in TC, some bomb blast or some natural calamity happened. Almost 50 plus employees got affected during this period. Then now it's a problem for LIC to compensate for all these losses. Suddenly releasing around 500 crores or 600 crores or 1,000 crores may be a big challenge for the LIC company, right? In that case, LIC company may join with others to share this tension. C. LIC has joined with Reliance Life, Birla Sun Life, okay? Birla Sun Life. So LIC says, I got a business order, very big one. I cannot accept the entire risk myself. So you share with me. Now BSL, Birla Sun Life will get the premium, a part of premium. I'm getting 10,000 lakhs, you'll take 4,000 lakhs. For that, you have to get committed for payment of compensation in case of emergency. 1 lakh lakhs, no, so you have to be ready for compensating me 4,000 lakhs. I'm giving the commission, so you have to give me the commission. Similarly, LIC gets the commission, so 40%. So here, 40% of LIC's business is shared with Birla Sun Life as per their terms of agreement. So whatever the business LIC gets is shared with another company. No, this is called reinsurance ceded. Reinsurance ceded. I am transferring a part of my business to others. So the red, the direct will be called direct insurance, and this green color highlighted discussion is for reinsurance ceded. Okay. Apart from that, okay, if Reliance Life Insurance, they got a big business, they cannot tolerate themselves to manage that big risk. So Reliance Life Insurance says, I will pay a premium of my share. Probably he shares around 60% of his big business. For that, Reliance Life Insurance make the payment of premium for LIC. LIC is now willing to take up some claim risk as well as paying a commission. This will be called reinsurance. Reinsurance accepted. Hope you will be now able to understand reinsurance ceded, reinsurance accepted, and direct insurance. This will be common for not only life insurance, for general insurance also this will be applicable. Let me finish up first of all that reinsurance ceded and the other concept. So here you need to understand, in case of claim, this is the expenses. Claim is the expenses. As well as commission payable is also expenses. Claim payable for the direct business is the expenses. And commission also for the direct business is the expenses. Plus reinsurance accepted, this one, reinsurance accepted. I get a part of the business from another insurance company, then the other insurance company demands some commission. So I'm paying him. So that insurance claim or commission payable will be also my expenses. If I'm not able to manage my entire business, then I'm sharing with others, which is called reinsurance ceded. While ceding, I'm getting the commission. That's just reverse, right? So minus reinsurance ceded. So commission or claim payable for reinsurance ceded, receivable here automatically. This is what about net expenses. Net expenses. The same happens in case of what? Premium. For the direct business, I get income. I get the income. For the reinsurance accepted, this one, I'm getting the premium. And in case if I'm ceding this, then I have to make the payment. Here the outflow is there, payment is there. So it should be subtracted. That's called about, this is all about net premium payable here. Hope you will be now able to understand this one. For making you understand this, let me finish up the illustration related to this first of all. If it is clear, text me. Make a note of it. Now, online students, come on, text me. For the reinsurance ceded and accepted, let me finish up an illustration. Then I will proceed with a comprehensive idea about all these things. Now, claim with reinsurance. Credential General Insurance Company supplies you the following information. You are asked to show the amount of claim as it would appear in the revenue account for the year ended 31st March 2022. Direct business and indirect business. Direct business and indirect business. These are the claims and the claims given. We have been given only direct business. This will be claims paid is for the direct as well as indirect business reinsurance accepted. This will be what? Reinsurance ceded. When you receive the claim, if you are sharing your business with others, then you will get the claim back. Okay. Now here we have been given opening balance as well as closing balance. Come on. Find out the actual claim. This is opening. This is paid. Closing payable is added, opening payable being subtracted to find out the net claims. Similarly, claims receivable at the end should be addable, opening should be subtracted. Find out the net claims. Direct, reinsurance accepted, reinsurance ceded. Claim received and paid. Received and paid. Here is all about paid. 90 lakhs 10,000. And reinsurance accepted 12 lakhs 40,000 paid. In case of ceded 3 lakhs 60,000 received. And add outstanding of the current year. 17 lakhs 25,000 should be addable. 65,500 addable. 1 lakh 90,500 addable. Minus outstanding of the previous year. 15 lakhs 8,500 subtracted. 1 lakh 55,000 subtracted. And 95,000 subtracted. Get me the final amount for your P&L account purpose. Revenue or expenses. Hope it is 92 lakhs 26,500. This one 11 lakhs 50,000 500. 4 lakhs 55,500. Now tell me the final calculation. Claims related. For direct business, the real expenses for the period being 92 lakhs 26,500. Right. Then add reinsurance accepted. For that also you have accepted. Now it's your commitment to make the payment. This value being 11 lakhs 50,500 minus reinsurance ceded. This value being 4 lakhs 55,500. Then final value here being 99 lakhs 21,500. Expenses of the management 4 lakhs 10,000, that's the general expenses, cannot be considered for the claim expenses. Out of that, expenses of the management included 61,500 as surveyor's fee should be includable. Surveyor is nothing but the amount payable for valuing real compensation or claim payable. On his certification only the final claim is settled, not absurd manner it may be paid. Similarly, if there is any litigation like 78,300 legal expenses for the settlement of claim also related to the claim should be addable here. So one is surveyor's fee and legal expenses. This value being 61,500, this value being 78,300. Now, final amount to be debited in your P&L account for claim here being 1,61,300. Clear? C. Insurance. Insurance business of two types. One is all about life insurance, another one is general insurance. In case of general insurance, we have three broader classifications. One is related to fire insurance, another one is related to marine, ship related. Last one is those not falling under this case. In case of life insurance, what are the content you have to study? Means number one, valuation balance sheet. Number two, disposal of surplus. Disposal of surplus. Finally, you have to prepare final accounts. Final accounts. In case of general insurance, you have to understand how to prepare unexpaid risk reserve. Unexpaid risk reserve. Apart from that, finance. As you know that banking, insurance, electricity, all the three chapters put together, only 10 marks possible. Definitely final accounts, a comprehensive final accounts in this chapter is not possible. Okay, most probably you can expect these kinds of illustrations. Especially in case of final accounts, you have to understand the format and some basic ideas of preparation of the final accounts related to the life insurance as well as general insurance. While preparing the unexpected risk reserve, you have to maintain 50% of the net premium as your unexpected risk reserve for fire. In case of marine, it is 100%. For other insurance business, it is again 50%. This is the main thing you have to understand. So we try to finish up first these aspects. What are they? How to handle the unexpected risk reserve as well as the valuation balance sheet as well as disposal of surplus case. This one itself guarantees you scoring good mark. All. Anyhow, we'll go for some other theory as well as final accounts also to finish up completely. Now see here, types of insurance policy. We have life insurance. For the accounting purpose, valuation balance sheet, disposal of surplus and final accounts, three aspects are to be covered. And in this life insurance, we have endowment policies. Endowment policies are the policies can be claimable by death or maturity. This is called endowment. And with or without profit policy. With or without profit policy is nothing but whatever the premium you pay, that may be invested with the insurance company somewhere. Incomes generated out of that, a share will be given to you. That's called policy-based premium. So it's a good one to cover your risk as well as an investment. So you safeguard your family. In your absence, your family will get a claims. But if you survey, what happens? You have to get some decent benefit as a return, right? So that will be called with or without profit policy. With the profit policy, you'll get some profit also. Without profit policy, I don't get anything. that I don't get anything can be named as whole life policy. Whole life policy means you'll get the claim only by death, not beyond that. So if we surveys, then you will not get. So these are varieties are there in case of life insurance. In case of general insurance, two predominant things are going to be learned for accounting. One is unexpected risk reserve as well as final account. Sometimes beyond this, that unexpected risk reserve stated here 50, 100, 50 may not be sufficient if you feel so. If the company feels so, they may have some additional reserve also to be created for the risk level also. Clear? So you have to understand these are the segments. This is 50, but there may be some additional also possible. So some terms are going to be discussed here. Before I go further, life insurance is a guarantee. General insurance is indemnity. Indemnity is nothing but the compensation you will be claiming or getting only for the loss faced. Guarantee is not so. Okay, you will get the money even if there is a loss or no loss, you will get the guarantee. Okay, if you meet with the accident, car accident, then you will claim the compensation for the car. Okay, if you are having the car insurance policy. If it is being the life insurance, even you survey after the maturity, you will get the compensation. That's called guarantee. So investment case like. You have to understand the main difference between life insurance as well as general insurance. In case of life insurance, is a guarantee. In case of general insurance, is an indemnity. Right. Now, insurance. A method of averaging risk is the meaning of insurance. Insurer, insurance company, insured the person insuring. Insurer is called indemnifier, insured is called indemnified. Who can insure? Who has insurable interest? Why do I want to insure my car? Because I have the interest, insurable interest. If car gets damaged, I may get the claim. I don't want to insure somebody else's car, okay, because I don't have any rights to claim any interest in that, right? Indemnity. You have to understand the term indemnity. Only the loser is compensated to the extent of actual loss. That is called indemnity. One cannot make profit by insuring his risk. He cannot make the profit. But life insurance is not so. Whether there is a loss or not, on maturity, you will get your money back along with some compensation. Small interest components also will be getting. That's why that life insurance is called as guarantee, and other insurance, general insurance, is called as indemnity. Insurance policy, a policy document. Double insurance. So if you insure with the two insurer or more is called double insurance. So in case of health insurance, you can insure with company A for say a coverage of 10 lakhs. You feel the 10 lakhs coverage is not sufficient because of the increasing cost of inflation index, you have to make it 15 lakhs. Then you can go to the same insurance company to top up another 5 lakhs to pay extra premium by paying the extra premium. Instead of that, you can go to the other insurance company where you can also make one more health insurance. That is called double insurance. So first, usually you claim the compensation from the first insurance company. If it is not sufficient, you can go to the next insurance company. Or first insurance company, your coverage is 10 lakhs, and second insurance company, you have the coverage of 5 lakhs. If you spend 3 lakhs, claim 2 lakhs from the insurance company number 1, another 1 lakh from the insurance company 2. That's how you can insure with the two different companies. That is called double insurance. Premium is nothing but the consideration payable for the insurance policy, and premium deficiency is otherwise named as where the premium is less than the cost of the policy. What is the cost of the policy? What the company, because of getting the premium, should respond? They have to pay the claim, commission, any other cost to administrate will be the cost. So that's what the cost of policy. For any insurance company, for any policy, the cost of the policy may be 1 lakh, means they fix the premium more than 1 lakh. The difference between the profit for the insurance company. Okay. Principle of abrame fide. So always the insurance company's policy will work under this principle, abrame fide. Okay. Means contracts of utmost good faith. It means whatever the drawbacks you have. So you have lots of health issues, and You will always spend huge money for your medical requirement. You hide that, and if you insure, then it's called not genuine one. So you have to disclose those health issues or other risk you have with the insurance company before you take the insurance policy. So insurance company gives a coverage only if the risk happens after taking the insurance policy. The risk what you have or any problem you have before taking the insurance policy will not be covered. So it's your duty before taking the insurance policy to disclose all of your troubles, right? That's called contracts of utmost good faith. Hence, each party must disclose every material fact known to him. Abrame Ude. Okay. Claim maybe you will get by death or by maturity in case of general insurance only. The claim by accident or real happening. In case of life insurance, you will get by either death or maturity. Surrender value also be applicable only in case of life insurance, where halfway through you can surrender and get a portion of money invested, and commission, bonus maybe in cash, and in reduction of premium, reversionary bonus, even we have interim bonus also. The final term is all about paid up policy. Paid up policy. See, sum assured being 1 lakh, term being 10 years, premium being 10,000 rupees. Isn't it? Usually, this is how you pay. But 5th year, you could not pay the policy, you want to cancel it. You have the two options. You cannot continue to pay 5th installment on options. So you have two options. One is surrender it. If you surrender, what is the amount you invested up to the 4th year? 10,000 per month, 4 years means 40,000. The 5th installment, you cannot make the payment. So 40,000 rupees you have invested. If you cancel it, the company will pay you only 30,000 rupees plus if there is any accumulated bonus also be payable in case of profit policy. This is one option. Or you have the another one. What is that? Sir, I cannot make the subsequent payments, sir. Hence, make the sum assured equivalent to the amount I paid, 40,000 like. So hereafter I don't want to pay. Anything worst happens in my life later on, pay me the compensation of 40 and any accumulated profit on that 40 in the later period. That's how whatever the policy premium I paid up to now will be final, and the hereafter I don't want to pay any further premiums called paid up policy. The policy payment is completely over. In this case, sum assured is proportionately reduced. How it is reduced? Sum assured is equal to original sum assured into number of premiums paid 4 and divided by number of total premiums paid 10. So 40,000 will be the revised sum assured. This is called paid up policy. Hope you will be now able to understand all these terms. So this is the one diagram, helps you to understand complete thing, and theory is also over. The main component that we are going to study is this one. So one after one. Let's now start with the first one. Valuation balance sheet. So what is called valuation balance sheet, sir? So valuation balance sheet is nothing but an income statement to determine the profit, okay? In case of life insurance business. Life insurance policy, they prepared income statement. Whatever the balance they get, is not profit. That will be called as life assurance fund. Maybe very first year, 1,000 lakhs. 1,000 lakhs. By telling the profit and loss, if they get any balance, that balance is not a profit. Because for insurance company, the policy amount being 1 lakh, premium being 10,000 rupees. If no claim is payable in the P&L account, they will have 10,000 rupees as premium received. No claim payable. Then entire 10,000 is what? Maybe profit. Maybe profit. If you assume this. In the next year, again you will get another 10,000 rupees. Suddenly he met with the accident and diminished. How much you have to pay? You have to pay compensation of 1 lakh rupees. Now you end up with loss. The amount what you receive as premium in the very first year, you are not responsible only for that amount. You are responsible for rupees 1 lakh. You receive only 10,000, but you are responsible for 1 lakh. How can you say that 10,000 received, still you are not paid maybe your income like, so it's not your income, because you are supposed to pay if it climbs later on. And next year also, we are not sure. So as we are not confirmed this 1,000 rupees or 10,000 rupees, whatever the amount we received is final gain. Any amount available in the P&L account as a balance is the life assurance fund. So premium received, commission paid, administration charges, everything is subtracted. Whatever the balance you get, which is called life assurance fund. Year 1. And in case of year 2, again P&L account for the year 2. In year 2, we'll start with the life assurance fund of the previous year and add the premium for that period, probably around 1,200 lakhs. And in this year, commission and other expenses spent, management on operating expenses spent, maybe around these two put together 300 lakhs. Now, what the balance now you have? Maybe 1,900. This 1,900 also life assurance fund. Clear? So every year the premium received, here the premium received being 1,100, the administration and other charges may be 100. Okay, commission and claim, whatever it may be. As you have 1,900 rupees balance in the P&L account in the second year, not necessarily that is the profit. The next year anything happen, you have to pay 1 lakh rupees, all the profit will go off. So once in every 2 years, now insurance company prepare valuation balance sheet once in every 2 years. In that case, this life assurance fund will be the opening fund here. Now, you have to determine what is the commitment the company has. What is the commitment the company has? What is the commitment the company has? How can we determine how many policies sold? Out of that policy, how many policies may be lapsed, so we are not liable to repay? And how many policies may mature on the nth period? How many policies we supposed to pay by death? In case of payment, maybe in case of death, then huge compensation is payable. Now they have to find out all this commitment to be met in over the life of the life insurance period. You have to determine the liability. That liability is called life assurance fund closing. This is probably around 1,400 rupees, is calculated by the actuarial scientist. It's a special study. Is that okay? Actuarial scientist. The actuarial scientist will be called, is the valuer. Asking him, sir, I have sold so many policies. Out of those thousands of policies, around 200 policies are supposed to be met, cancelled, and some policy may be cancelable later on. So based on all this permutation combination using the probability, what is the expected liability this company has is calculated by the actuarial scientist. That is the closing life assurance fund. After that, the balance what you get, this is the actual profit and loss for the business. Clear? This is the actual profit. Any doubts here? This will be shared to whom? Shareholder and policyholder. It's not only for the shareholder, because major amount available in the insurance company is the amount received from the policyholders as a premium. The company started with a small contribution by the shareholder, and lots of amount is received only from the policyholders. So whatever the amount you get as final profit, out of which 5% will be the amount payable to the shareholders. This is called dividend to the shareholders. 95% is allotted to the policyholders only. This calculation will be done once in every 2 years. Is that okay? Once in every 2 years. But anyhow, this may not be payable immediately. May be payable now and then. Call interim before the calculation. Okay. So once in 2 years, if you are calculating, a policyholder supposed to withdraw 6 months earlier, no, he may be losing, right? So because of that reason, now and then an estimated value will be allocated to all these policyholders called interim. And final amount may be payable, balance. That balance may be either payable in the form of cash or in the form of reduction of premium, or it may be payable along with the expiry, means maturity value, reversionary bonus. Is that clear? These are the possibilities are there. Hope now you'll be able to understand this one. Actuarial valuation determination of liability for life insurance. valued once in every 2 years. Once in every 2 years. By preparing the valuation balance sheet. In case of general insurance, valued if insurance term is more than 4 years. Okay. In case of general insurance, it may be valuable every year, but if the term is more than 4 years, then it may be properly valued. Is that clear? Hope now you'll be able to understand. Clear? Now, let's try to solve the illustration. So we have completed reinsurance, ceded and accepted. We'll start with valuation balance sheet now. Valuation balance sheet. The life insurance fund of Bharat Life Insurance Company Limited was 50 lakhs on 31/3/2022. The actual valuation on this date disclosed a net liability to this one. So what is the opening value? Life insurance fund in the beginning 50 lakhs. What is the net liability? Life insurance fund closing is the net liability 42 lakhs 50,000. Is that okay? Now, the difference between these two, 7 lakhs 50,000, 50 lakhs. Now, this 7 lakhs 50,000 is a surplus, can be distributed. Is that okay? So, surplus in this case being 7 lakhs 50,000 rupees. An interim bonus 80,000 was already paid to the policyholders during the previous 2 years. Any premium payments, interim bonus paid during the 2 years itself should be added back to arrive what is the actual profit for the entire 2 years. This 7 lakhs 50,000 rupees only after the subtraction of the interim bonus is no, so you have to add the interim bonus back. So add the interim bonus. ₹80,000, then final value being 8,30,000 rupees. It is now proposed to carry forward 1,50,000 and to divide the balance between policyholders. So another one is reserve GR. Out of the 8,30,000 rupees is the profit we earned over the 2 years period. By preparing the valuation balance sheet, we found out the surplus, which is 7,50,000 rupees. Not only that, this 7,50,000 is only after the interim bonus. So what happens if it is before interim bonus? It is 8,30,000. Out of that 8,30,000 rupees, one part is going to be kept away for the future requirement called as GR 1,50,000. Now, what is a disposal surplus or distributable surplus? Come on, tell me. 6,80,000 rupees is the disposable surplus. Okay, surplus to be distributed. In this, policyholder will get how much? 5%. Sorry, shareholders will get 5%, and policyholder will get 95%. 5% being 34,000, and 6,46,000 will be for policyholders. While making the payment to the policyholder, we have to subtract this 80,000 rupees because 6,46,000 is the profit identified to be shared to these policyholders. But I am stating them, you have already received 80,000 rupees, so I am going to subtract that 80,000 rupees. So balance be 5,66,000 is payable now. 5,66,000 is payable now. Clear? Clear? That's how you can find out the valuation balance surplus to be distributed. So what are the requirement here? Valuation balance sheet, net profit for the 2 years period, distribution of profits. All these things are going to be calculated. So we have completed. Question number 2. The same way. From the following figures of Livewell Assurance Company Limited, prepare a valuation balance sheet and profit distribution statement for the year ended 31st March 2021. Also pass necessary journal entries to record the above transactions with narration. Balance of life assurance fund as on 1/4/2020 167.15. Interim bonus being 25. Balance of revenue account for the year ended this being. So I have to calculate the valuation balance sheet only for this period. You know, valuation balance sheet for 31st March 21. Is that okay for this period? And P&L account of that period 31/3/21. What the balance showed is 240. That 240 is the life assurance fund. Transferable here. Okay. Actually, student got confused in the examination. In valuation balance sheet, we'll start with life assurance fund. You know, on 1/4/20 we have been given life assurance fund, but we need to get the life assurance fund as on 31/3/21. That is missing. But as on the date, the balance in revenue account is 240. The balance of revenue account is nothing but life assurance fund. You have to understand this carefully. I need the life assurance fund as on the date of preparation 31st March 2021, not earlier to that. So 1/4/2020, we have the life assurance fund, but that is not my requirement. I need to get the life assurance fund for 31/3/2021. The life assurance fund is nothing but the balance of the revenue account. Okay. So it is otherwise named as balance of the revenue account. So 240 will be taken. Net liability as per the interim valuation being this one. So net liability here 165, and the balancing figure will be the surplus. The surplus here being how much? 75. 75. Now there is an interim premium bonus fee. So find out that. $240, 75 is after the interim bonus. You have to add the interim bonus 25. 95 is the total surplus. This will be segregated. There is no any transfer amount. Segregated to policy holders, shareholders and policy holders. For shareholders it is 5%. For policy holders should be 95%. 95% on this. Oh, this one is 100. Okay. So 95 will go for policyholders, 5 will go for the shareholders. In that 95, already we paid what? Interim bonus. Now we have to subtract this one. 25. Balance 70. Balance 70. Balance 70. Is that clear? Now, the sum is not over with this. This one paragraph is so important here. Let me finish up this paragraph here. Now, the company declared a reversionary bonus of 185 per thousand and gave the policyholders an option to take bonus in cash 105 per thousand. So there are options available. As there is a surplus, it should be distributed, then it may be given as an option. Do you want to get it in cash or do you want to consider this being the reversionary bonus? The total business conducted by the company was 600 lakhs. 600 lakhs. The company issued profit policy only. Profit policy means all the policyholders are eligible for profit share. Whole life policy, they don't get anything in the between. So with or without profit policy also there, right? So without. In case of without policy, what the amount invested, they will get only that. They don't get any profit. But all the policyholders are now getting the profit. In that 600 lakhs, 3/5 policyholders value after for cash bonus. 3/5 after for cash bonus. Then balance 2/5 after for reversionary bonus. Reversionary bonus. Is that okay? 3/5 of this. Those after for the cash bonus will be offered cash rupees 105 per 1000 rupees of their policy amount. In case of reversionary bonus, of course, the money is not payable now, may be payable later on. So, extra income payment also be done, which is 185 per 1000. Now, come on, get me the first value. $37.8 and this one being 44.40. Now I'm going to pass the journal entry. Now, how much fund is transferred from life assurance fund to profit and loss? Step number 1. 240 was there in life assurance fund. On confirmation, we need to have net liabilities of 165. As net liability is only 165 only, we have to keep the life assurance fund only to that extent. Beyond that, we have surplus rupees 75. Beyond that, we have surplus rupees 75. This surplus can be transferred to the P&L account for distribution purpose. Number 1. Number 2. Out of this surplus, we may offer this as a cash bonus. Another one is it may be offered later on as a reversionary bonus. You have to pass 3 entries. Number 1. Life assurance fund debited, transferred to P&L account. To P&L account. This value being 75. From the P&L account, I am going to distribute cash bonus immediately. So P&L account debit to bonus in cash, interim bonus or final bonus in cash. How much is that? 37.80. What about this 44.40? Payable not now, later on. If you are supposed to pay later on, 3 or 4 years later, what about that payment? Payables being outstanding. Outstanding is a liability. Again, it becomes liability. Liability means can be added to life assurance fund. It's a company's liability. So, profit and loss account debit to life assurance fund. To life assurance fund. The value being 44.40. 44.40. Okay. This is all about reversionary bonus case. This is all about cash bonus case. This is what about the transfer of the amount from life assurance fund to P&L account to the extent not required to maintain in life assurance fund. These are the 3 entries you have to pass. So we have completed valuation balance sheet. Right. And disposal of surplus also. Additionally, you have to now understand annuity business of life insurance company. This will be applicable only for the life insurance company. In life insurance company, in their P&L account, they get the premium, they pay the claim by death or maturity, surrender value and all. Apart from that, they get the consideration for annuity, and periodically annuity will be payable, pension. During their working age, they will start depositing small amount for the annuity, which is called consideration for annuities. It's a income for the insurance company, life insurance company. After certain age, from that amount, pension may be released. That is called annuity value. This option is available only for the life insurance, not for the general insurance. Okay, annuity, annual payment or pension to the investor is the expenses for the life insurance company. And for that consideration is received, this is the income for the insurance company. Insurance company. Okay, let me try to finish up the third question here. The revenue account of life insurance company shows the assurance fund in the beginning being 75 lakhs before taking into account of the following. So life assurance fund 75 lakhs. Some items were missed. These are the things that are going to be adjusted. Claims covered under reinsurance 315. Income tax on the above being 35,000. These are the expenses. IT. 35,000 is the expenses to be subtracted. Claims being the revenue, you can add it. But claims intimated, so you can do plus or minus here. Claims intimated, direct business, the value being 8,15,000. And claims under reinsurance can be subtracted from here. Reinsurance, if nothing stated, if you have the doubt whether it is a reinsurance accepted or reinsurance ceded, first priority goes to the reinsurance ceded only if it is not stated properly. So 315 is the revenue. Here this value being 5 lakhs, 35,000. And bonus in reduction of premium. Bonus in reduction of premium usually should be added as it is a part of premium. Bonus in reduction of premium should be addable. Bonus in reduction of premium. How much is that? 4,25,000. Don't forget to subtract that one also. Bonus in reduction of premium. Usually nothing stated means it should be added and subtracted. In your P&L account, bonus is payable 425. Premium receivable being 1,425. That's how you can assume. I asked that policyholders, as I am supposed to issue the bonus, are you able to take this bonus or not? They will say, okay, we'll take. This bonus is going to be subtracted from here. So naturally what happens, only 1,000 rupees is credited, bonus will appear 0. The premium what we have collected is net of bonus payable to them. So we have subtracted. So in our P&L account credit side, we show only 1,000 rupees as the premium. In the debit side, we show 0 amount for the bonus. Actually, bonus 425 should be there. Premium 1,425 should be there. While collecting the premium account premium account credit, okay, 1,425. While paying the bonus, 425 is payable, but net payment being receipts being bank. How much? Only 1,000. This net amount is transferable to the P&L. That's the logic. That bonus is also be cancelled. Premium is also cancelled. Net value 1000 is shown. Whenever bonus in reduction of premium, the actual value to be shown in the P&L account is inflate the bonus 425 in the expense side. Inflate the premium also in the income side 425. So it will have no impact after this adjustment if nothing state. Nothing state. Bonus and reduction of premium. Dividend from investment, additional revenue. Dividend from investment, dividend received. Value being 3,20,000. Outstanding premium, also revenue. Existing premium, with that this outstanding premium should be addable, that value being 25,000. Then overall value being 7,70,000 rupees. The overall amount to be subtracted being 9,60,000. From 750 add 770, subtract 960. 73,10,000 is the adjusted life assurance fund. Adjusted life assurance fund. Clear? Adjusted life assurance fund. I have solved already the book bag problems. I request you to go and see those book bag problems yourself from the shared material, right? Now, next question. See, we have completed valuation balance sheet, disposal of surplus, and also an illustration related to the claim and other thing. Now we'll try to finish up the unexpired risk reserve. You have to create unexpired risk reserve of 50% on the net premium. Net premium means premium received from direct business, reinsurance accepted business. These two are added. Minus reinsurance ceded business should be subtracted. The balance will be ultimately transferable. In this revenue, 50% will be kept aside for the future unexpected risk reserve. Balance only transferable. In case of marine, the entire 100% will be kept aside. See, in your P&L account, premium, net premium being 1,000 and expenses being 300 rupees. What is the unexpected risk reserve you have to create in case of fire insurance? Usually 50%. In this net premium 1,500 rupees will be the unexpected risk reserve. Then surplus transferable to the P&L account being 200 rupees. The profit identified being 200 rupees. In the next year, what is the premium they have? We assume the premium in the next year is growing by 10%. 1,000 becomes 1,100. Expenses and claim for the next year being 400 rupees. Naturally, previous year unexpected risk reserve becomes opening unexpected risk reserve credited in the P&L account. Is that clear? What is the unexpected risk reserve you have to create in the current year? Every year, whatever the net premium you have collected on that, 50% will be created, otherwise 550 rupees. Is that clear? The closing unexpected risk reserve becomes the opening for the next period. Every year, the closing unexpected risk reserve should be URR should be equal to the 50% of the premium in that year, net premium. Now, if you tally then surplus or profit identifiable in the current year being, come on, how much is that? 650. In case of marine, sir, what happens? In case of marine, in the very first year itself, how much I create? 1,000 rupees. definitely in the very first year there will be loss. Isn't it? The entire premium will be created. See, in case of marine, assume the same things are happening. Premium being 1000, expenses here being 300. What is the unexpected risk reserve? As it is being the marine, 100% of the premium will be created and your net loss being 300. In the next year, unexpected risk reserve being 1000, the premium collected in this period being 1100, expenses for this period being 400. What is the unexpected risk reserve to be created? For the current year premium, 100% is 1100 to be created. So 2100. 600 will be the surplus in the next year. So in case of marine, the profitability is transferred to the next period. In the very first year, we don't recognize it. Now, if you feel that this creation of 50% URR for fire is not sufficient enough, you can better create another 10% or 20% based on the information given in the questions. Standard being 50, 100. Okay, in case of marine 100 and fire and others, it's a 50. Similarly, in case of surplus of LIC, 5% will be for shareholders, 95% is for the policyholders, right? This is the main points you have to understand. Come on, we try to solve the illustrations related to this one. URR. So how can you pass the journal entry for the CRR for closing as well as opening? Very simple, right? So for the opening URR, journal entry being URR account debit to P&L account or revenue account. For this P&L account debit to URR. That's how you can pass the entry. Or you can pass a summarized combined entry also. 550. No, combined entry means you are increasing another 50 rupees only. You are increasing another 50 only. So P&L account debit to URR. Rather than passing these two entry, you can simply pass one entry this way also. Is that clear? Now, usually you may be asked to pass a journal entry for the URR for the opening as well as closing or combined manner along with the ledger account for the URR. So we'll see an illustration that, right? Now, unexpected risk reserve. Following informations are provided by Rashtriya Bima Company for the year ended 31st March 2022. On 1st April 2021, the unexpected risk reserve was in respect of the insurance business 52 50. This is for marine in the beginning, opening URR. In respect of fire insurance business 55 and in respect of miscellaneous insurance business 12.5, 55. It is a practice of the company to create reserve at 100% of the net premium income in respect of marine insurance policy and 50% net premium in respect of fire and miscellaneous. The second point is the default. If it is not stated, you have to take 150. If it is stated, no problem. The number given will be taken for your solution. Now, insurance insured in respect of policy issued. This is called direct business. Other insurance company in respect of the risk undertaken. So, other insurance company, but we have undertaken, then it is called reinsurance accepted. And premium to the other insurance companies on business ceded. So, it is a foregoing of this. So, you have to add these two and subtract this. This will be the net premium. Come on, tell me. 57 plus 17.5 minus 22.5. 52.5. Okay, 52.5. And here, is it 50? Oh, 52. Okay, this is 52. This one, 60.5. This one, 15.75. Is that clear? Now, what about the URR to be created? URR to be created. This is marine, 100% for rest of the two, 50-50 you have to create. In 52, 100% being 52 is the CRR closing. For fire, 60.5, 50% on this being 30.25, and for others this is 121. Which one 121? Okay, 121. Sorry, this is 121. Yeah, thank you. As this is being 121, 50% created 60.5. Here, tell me 31.5. You have to create 50 percentage 15.75. 15.75. Now, opening how much they have for marine 52.5, for fire 55, for miscellaneous 12.5. From this, it is very clear. Marine, we need to create another 0.5 excess. Creating 0.5 excess is debited to the P&L account. Okay. Sorry, reducing. 52.5 is the opening, closing being 52. You are reducing 0.5. You are reducing 0.5. Reducing 0.5 means you can transfer to the revenue account. So the entry being unexpired risk reserve marine account debit to revenue account marine 0.5 lakhs. Either you can pass a single entry or you can pass two entries also. Journal entry for the opening URR and closing URR. For the opening URR, the entry being URR account debit to revenue account. For the closing, revenue account debit to URR. That's how you can pass. And in case of fire, initially 55, closing 60.5. So 5.5 additionally you have to create. So revenue, fire account debit to URR fire account. The value being 5.5. The value being 5.5. Similarly, in case of others 12.5 earlier, now 15.75. 3.25 further you are creating. So revenue account for others account debit to URR account for others 3.25. So what are the requirements? Pass necessary journal entries relating to the unexpired risk reserve. Also show necessary unexpired risk reserve account also in columnar form. In columnar form. I can prepare in columnar form here. In columnar form. Okay. Now, URR account. URR account. For marine, fire, others. Marine, fire, and others. What is the opening balance they have? This is a reserve only, no liabilities items. So opening balance here, closing balance here. Opening balance being this one 52.5, 55, 12.5 is the opening one. Closing being 52, 60.5, 15.75. Now for marine, URR to revenue account. URR to revenue account. Marine 0.5 will be posted here. URR revenue to URR. So here revenue account should be posted in the credit side of fire 5.5. Here also 3.25. Hope it will be now tallying. So URR account is over. So before I start with the final accounts, let me summarize the concept what we have discussed here. Insurance. So we have life insurance and general insurance. In case of life insurance, the content what we have to cover is valuation, balance sheet preparation, disposal of surplus, and final accounts. Okay. In case of general, we have to prepare URR, unexpected risk reserve, and final accounts. And commonly, you have to understand claim, commission, as well as premium and all from the direct business, add reinsurance accepted case minus reinsurance ceded case. These kinds of questions you may be expected. We have completed this one. Is that okay? Number one. Number two being preparation of an adjustment statement for finding the correct revenue account. Okay. Finding out. Okay. Find out correct life assurance fund. This is very, very important. They may give the life assurance fund after missing out of these items, like, so you have to understand how to do plus or minus to get the final answer. These are the two kind of additional illustrations you can expect. Currently, we have completed this one. For this, we have completed with the claim only. The same is applicable for what? Commission as well as premium payment also. We have understood the preparation of valuation balance sheet completed once in every 2 years. Whatever the balance you will get in revenue account is called life assurance fund. Once in 2 years from the life assurance fund, we will identify the profit share. The profit share identified will be disposed to the various parties. To the shareholders 5% as well as to the policyholders is 95%. The payment may be immediately done by way of cash or registered with the premium payable, or finally it may be repayable later on, not now called reversionary bonus. So we have seen all these cases. And how do I create the URR, unexpected risk reserve? So unexpected risk reserve for marine being 100%, for the fire and other business it may be 50%. In case of fire and others, if 50% is not sufficient, you can create additionally another 10 or 20% also, as the case may be. Only these kinds of questions you can expect predominantly in your examination, or some small terms also may be expected, whether it is a guarantee or indemnity and all. In case of final accounts, you have to understand the format. Here, the final accounts related to the life insurance business going to be studied. The final accounts for the general insurance business is also be studied separately, because these two are not same. In case of balance sheet, in both the cases same, but in case of revenue account, final accounts, revenue account for the life insurance business is different, and revenue account for the general insurance business is different. Where, see here, we have to prepare revenue account as well as we have to prepare balance sheet. Under life insurance corporation or general insurance corporations, balance sheet will be same. Balance sheet will be same, but revenue account are not same. Is that okay? And along with the revenue account, valuation balance sheet is also prepared. Valuation balance sheet also prepared for LIC. It is not applicable for GAC. And small difference is there between the revenue account of LIC as well as revenue account of GST. This may be totally different. Okay, let's see. Let me start with the LIC company's final accounts. After that, I directly jump to GAC company. Right. Yes. Try to understand the formats here. Let me finish up the format first of all. Now, income statement as well as balance sheet. Income statement and balance sheet. In case of revenue account, revenue account, form A or A, form A revenue account, RA in short. That's how the form is named. Okay, Schedule A, Schedule A, Form A, Schedule A, Form A. Okay, and here Schedule A, Form A, BS, Form A, BS, balance sheet. These are the two schedules we have. Balance sheet is very simple for both. Shareholders funds, SHF, start with share capital, reserves and surplus, borrowings, schedule number 5, 6, 7. From this it is very clear. Up to 4 we have income statement. Our income statement has 4 schedules total. Then applications of fund. Applications of fund. Current assets and current liabilities are shown separately. Investments 8, loans 9, fixed assets 10, and we have current assets. Under the current assets, cash and bank balance 11, advances and other assets 12, current assets. And from current liabilities and provisions, current liabilities and provision, current liabilities will have schedule number 13 and 14 total. You understand? Then you can find out the net current assets. Net current assets. Okay. I name this being A, B, C, D. Net current assets should be the difference between C and D. And you can cross verify the sources of fund. Okay, shareholders funds. A should be equal to the application fund as well as net current assets E. Finally, you can cross verify. A should be equivalent to B plus E. B plus E. How should appear in the case of income statement? In case of income statement, we'll start with income, especially first one being the premium. Premium. Schedule number 1. And commission Schedule number 2. And operating expenses. Schedule number 3. Benefits paid. Benefits paid. Schedule number 4. So, schedule number 1, after we have a space here without any schedule representing whatever the other income we received now will be posted here, like income from investment or consideration received from policy holders for paying the annuity and all later on, right? So if you subtract the income minus expenses, you'll get the surplus. The surplus will be then appropriated. The second part will be the appropriation. These are the formats you have to understand. Okay. In case of general insurance, the first part is totally different. First part is totally different. Balance sheet will be the same, but income statement will be total. Revenue account will be totally different. Is that clear? Yes. In case of LIC company, you understand? Policy holders. From the policy holders, what they will get? Premium. And what they will offer? Claims by death, maturity, even halfway through surrender value. Surrender value. So for one receipt, these are the 3 things are offered. Not only that, they have to offer what? Bonus. Bonus is what? Maybe interim and reduction of premium and reversionary bonus, cash bonus, all these things are offered. For receipt of one premium, these are the expenses are payable. Apart from that, this is routed through agent only, no. That's why LIC makes the payment to the agent also named as commission. Clear? So from the LIC, from the amount received from the policyholders by the LIC offers to the policyholders by way of either claim and bonus. Apart from that, the LIC company will collect a consideration for annuity. After the maturity period, after the expiry of the term, LIC has to pay the annuity. Periodical payment is called pension. Periodical payment. So 2 types of revenue are generated or received from the policyholders. One is premium for the policy, another one is consideration for annuity. For the premium, almost 7 items are going to be offered, and for the consideration for annuity is payable. What the company will do then? The company will keep all the money invested either in shares or securities or bond, whatever it may be. For that, LIC will get dividend and any other interest or any other revenue. Okay. Now, this will go to the schedule number 1. This will go to the schedule number 1. This will go to the revenue account income side. We don't have the schedule. And this one also will go to the revenue account in the credit side without any schedule, right? So we don't have it. For that only I have left this one. What are they? Income from investment, and consideration for annuities. Not only that, some other revenue also be possible, other revenue. So income from investment, consideration for annuities, other revenue also possible. What is the other revenue? Policyholders suddenly want to change their address, registered with the insurance company, name transfer, any other request made by the policyholders to the LIC. LIC will do that for a small money. If the policyholders are making the payment late, LIC will demand some extra compensation like either additional interest or fine, penalty and all. levied by LIC and the policyholder, no, those things are the other income. So the consideration for annuities, income from investment, other incomes are appearing the credit side of the revenue account. We don't have the schedule. Premium will be shown in schedule number 1, where premium received from the direct business, reinsurance accepted business minus reinsurance ceded, that's the final value. From that, you can transfer here as a life insurance fund and all. This is the logic. And the claim bonus and annuity, all these things are called as benefits paid, falls under schedule number 4. Benefits paid. Okay, in case of general insurance, we don't have the benefits paid. Instead of that, we have the claim paid. Only because of the life insurance policy, either it may be claim, even though in case of claim by death, maturity, even surrender value possible. But in case of sharing of the profit by way of bonus, named as interim bonus or bonus payable by reducing the premium or adjusted the premium, reversionary bonus and cash bonus, all sort of benefits are offered. That's why it is termed as benefit paid, and in case of general insurance, it will be named as claims paid. That too, this will come here as claim paid. In case of general insurance, premium number 1 and claim paid number 2, claim paid number 2, and 3 being commission, 4 being operating expenses. That's all. So the fourth item will come in the second place. Rest of the things are the same. We don't have any other income from investment as well as other income, very rare. And that too, you have to prepare for the marine, fire and others separately in columnar form. After finding this, the ultimate value will be transferable to the balance sheet in a consolidated manner. In case of balance sheet, it's a consolidated. So that balance sheet resembles like the balance sheet of the life insurance business only. Only income statement is pretty different. Is that clear? Hope you'll be able to understand this one. And in case of marine and fire and others, we have to prepare URR also. You have to keep this idea in your mind. Clear? Any doubts here? So, in your balance sheet, 3 is for the shareholders' funds and liabilities, 3 is for the application from non-current, and 2 for current assets, 2 for current liabilities and provisions. From the current assets minus current liabilities and provisions, the value what you get is nothing but net current assets. So, shareholders' funds, with that, if you cross verify whether the application of fund and net current assets are tallying, if equal, then it is final. It is final. Clear? Hope you will be able to understand this one. Okay. Shall I solve an illustration here? It's a comprehensive illustration going to be solved now. Clear? You can have this idea in your mind. From the following trial balance of National Life Insurance Assurance Company Limited, prepare revenue account and balance sheets. A comprehensive illustration. Let me start here. I open the schedules here. Yes. Join with me. What are the schedules you have to open? We'll start with first one, premium. Second one is commission. Third one is operating expenses. Fourth one is benefits paid. benefit benefits paid will have more component, gives good space for that. 5 being share capital, 5 6 7 share capital, resource and surplus, and long term borrowings. Share capital, resource and surplus. 7 being borrowings. 8 investments. 9th loans. 10th fixed assets. 11th cash and bank. 12th advances and other assets. 13 current liabilities. 14 provisions. 15 miscellaneous. Contingent liabilities if any. Okay, miscellaneous. But in your balance sheet, up to 14 will appear. This will be the below the balance sheet items. In this illustration, management expenses due. Put the dot for all the adjustments. Here is another one being premium outstanding. So there is an adjustment for the premium. Here there is an adjustment. And reinsurance premium ceded, also one more adjustment. So we have 2 adjustments for premium. And interest accrued, adjustments for interest. Here is. And then surrenders against loan. Surrender is there. In surrender as well as it is against loan, so loan will also be adjusted. Put the dot for the loan and surrender. So here is. Okay. Then further bonus utilized in reduction of premium. Bonus in reduction of premium. So you have to adjust for the bonus in reduction of premium as well as premium. 3 adjustments. Further claim intimated, maybe outstanding claim like this one. And finally claims covered under reinsurance. So we have reinsurance also here. Sorry. Okay. I put the dot wherever we have the adjustments. Now let's try to finish up the credit balances first of all. We'll finish off credit balances first of all. Yes, come on, tell me. How will you record the life assurance fund? Life assurance fund is the opening value appearing in the balance sheet as opening value 14,70,562. Opening value. Premium. So here is premium 2,10,572. We have 3 adjustments. Consideration for annuities granted. Where will it appear? Consideration. These are the special income. Okay, we'll go directly where? In your income statement. I'll score out this. It'll come here. Yes, tell me. Consideration for annuities 10,620. Interest, dividend, and rents, income from investment. Am I right? The value being 52,461 subject to adjustment. Fine and penalty. It's a revenue for the insurance company. Fine and penalty payable by the policyholders because of the delay in payment and all. That will be revenue. Annuities due but not paid. Annuities due but not paid. What is that? It's a liability. We're supposed to pay. We'll go to the current liabilities. Maybe matter of 1 or 2 months later, I have to pay this. So current liabilities 22,380. Okay. Current liabilities. Annuities due. Annuities or outstanding annuities. Okay. What's the value? 22,380. 22,380. Clear? 22,380. Then shares being 4 lakhs. Shares being 4 lakhs. We'll go to the share capital. Equity share capital. Value being 4 lakhs. And claims admitted but not yet paid. We are admitted to pay but not yet paid. Then outstanding claim. Liability side. Outstanding claim. The value being 80,034. 80,034. Is that clear? Hope now you'll be able to understand. We have posted all these items here. Credit side over. Credit side over. You can go to the debit side. In debit side, let me finish the first few items here, from here to here. Yeah. Tell me. Claims by death. Claims by death. All these things are benefits paid. Claims, bonus, and annuity. All these things are the benefits paid. So claims by death. Value being 76,980. Maturity 36,420. Management expenses 19,890. Operating expenses, that's a part of operating expenses. Dividend paid being an appropriation, so from the P&L account it should be subtracted. So I put the value here, 20,000 rupees. Dividend paid. From the surplus, this is going to be appropriated. It has no schedule, so you have to be careful here. Commission, already we have a schedule for this commission. 26,541. Income tax and interest, etc. What does it mean? Advance tax or TDS. TDS is your asset. We'll go to the current assets. Is that okay? Income tax on interest, advances. IT on interest. TDS, value being 3060. Surrenders. Surrenders are also part of payment. Benefits paid. Rather than waiting for the maturity, policyholders may claim to pay now itself to settle his own due. 21,860 subject to adjustments. Annuity is also paid. Annuity is also paid. These are the benefits. So what are the benefits are there? I just already stated all those things. So 29,420. Bonus paid in cash. Bonus paid in cash. Also benefits. Cash bonus. Cash bonus. 9,450. Hope now you'll be able to understand all this part. First set to over. Second set. We'll now move on to this one. Bonus in reduction of premium. bonus in reduction of premium. Adjusted in premium. Reduced, premium reduced. Value being 2,500. Of course, we have adjustment for this. Preliminary expenses, you can score out this usually subtracted from this share capital. So 4,99,000, sorry, 3,99,800. Preliminary expenses. And government securities are the investments. I posted value in the investments, so government securities, G-SEC. Can very easily guess all these things. 8,70,000 rupees, 8,70,000 rupees, 890. Furniture, fixed assets. Furniture, fixed assets, 20,000 rupees. Mortgages, loans and advances given. Policyholders will get the loan from the insurance company itself, mortgaging their own property, even their own insurance policy. So here we have mortgage advances. Loans given as said, it's not liability. 3,09,110. Then loan on company's policy. Loan on company's policy. Policy pledged and loan is borrowed 2 lakhs rupees. Freehold premises, fixed assets, premises, 3 lakhs. Leasehold ground rents may be named as fixed assets or investments. Okay. So leasehold ground rents may be assumed to be the fixed assets or investments. Sometimes logically, this seems to be an investment only because they are not going to be the owner for the property. They have taken in lease. Few years later, you have to return the asset and get the money back. That's why the amount invested is considered as investment. House property is the fixed assets. 1 lakh. So I have posted all these things. Now we have been given these 8 adjustments. One after one. Management expenses due. What will you do? So you add here. How much is that? Management expenses. 600 is going to be addable here. Another place, as it's outstanding liabilities, no? Outstanding management expenses. 600. And go to the next one. Premium outstanding, revenue outstanding. Okay. Add outstanding. 7,400. Again, it's an asset for you. Outstanding premium. 7,400. Reinsurance premium ceded. Due. Reinsurance premium ceded. Ceded means it's your duty to pay it back. Okay. Minus reinsurance premium ceded. 6,000. 6,000. Not yet paid, it's a due. Not yet paid, it's a due. Then it's form of current liabilities. Outstanding premium on reinsurance ceded. The value being 6,000. Reinsurance ceded. Interest accrued 15,400. So we have interest here. Add accrued 15,400. As it is receivable, named as your current asset, so accrued interest 15,400. 15,400. And we have surrenders against adjusted against loan. See, some policy holders surrender their policy. This value being 5,000 rupees. Surrender means we have to offer the money, no. But this particular policy holders has pledged their policy and got the loan. Surrender value, rather than paying for his own requirement, simply adjusted in the loan account. Surrender. Policy holder can surrender his policy and can get the loan. In this particular case, he has borrowed already loan by pledging the policy. So the surrender value, rather than returning, is adjusted with his own loan account. Clear? This is the main concept you have to understand. Further bonus utilized in reduction of premium. Further bonus utilized in reduction of premium 1,500. So here it should be a part of premium also. Bonus in reduction of premium 1,500. Bonus in reduction of premium further 1,500. Double entry like. I adjust here as well as here. Clear? 1,500 and 1,500. Then further claim intimated. Okay, further claim intimated. Intimated, now it's our duty. So outstanding. How much? 8,000 rupees. Why it is outstanding? Just now intimated, we have not paid. Just now they have intimated to pay 8,000, we have also accepted. That becomes our outstanding current liabilities. Okay, 8,000 rupees will be addable here. Already there is a 80,000 rupees 34 claim outstanding. With that, another 8,000 should also be addable. Last one being claims covered under reinsurance ceded. If nothing stated, that is always reinsurance ceded only. So 10,000 could be reinsurance ceded. So that will be adjusted here. Minus. Okay, minus. Okay. Reinsurance ceded 10,000. Negative value. And the 10,000 will be part of what? A recoverable amount? No. So outstanding claim for reinsurance ceded, recoverable being your asset. Hope I have posted all these values. Now finish off tallying, finishing each and every account independently. Here this is minus item. Yes, tell me what is the total of premium? Yeah, 2,13,472. Commission no adjustments. Management expenses 20,490. And benefits paid, I think you will be getting 1,81,130. Wherever there is minus, you have to do deductions also. Claim reinsurance ceded is minus item. Share capital over, and borrowings we don't have any balance, and investments 10,70,000 rupees 890, and loans being you have to subtract 5,000 rupees, so 5,04,110, 5,04,110. And in case of fixed assets, this being 4,20,000. We don't have the cash in bank, and advances and others 35,000. One item is missing, I think. Stamps somewhere given. Yeah. So we missed the stamps on hand. Also, conducts. I include that. Stamps. Come on, tell me. Then the ultimate value here being 36,260. Current liabilities being 1,17,400. 14. No provisions, no miscellaneous. Finish up the income statement first to finalize what is the profit transfer to the P&L account. Are you getting this value? No. This is 80,034. This is 80. Okay. Then this value being 2,13,472. 2,13,472. Schedule 2 balance being 26,541. In operating expenses, 20,490. Benefits paid 1,18,130. 1,81,130. Yeah. So income from investment being, if you add these two, 67,861. The total of schedule number 1 and income 2,92,045. 234, if I add the 3, then the total being 1,81,000. How much is that? Come on, total. 234. If you add up the 3. Two lakhs 28,161. If I subtract this from the income, surplus being 63,884, balance carried forward to life assurance fund 43,884. I add this with life assurance fund 43,884. Now the total of life assurance fund here being 15 lakhs. Yeah, 14,446. Now I had to transfer all these things. Schedule number 5, 3,99,800. Schedule number 6, 15 lakhs, 14,000. 15 lakhs, 14,446. 446. Borrowings dash investments one lakh 7,000, sorry, 10,70,890. 10,70,890. Loans 5,04,110. 5,04,110. Fixed assets 4,20,000. Okay. Current assets, cash we don't have, only advances 36,260. Current liabilities being 1,17,014. We don't have the provisions. Come on, total the shareholders' funds 19 lakhs 14,246. This will be 19 lakhs 95,000, and this will be 1,17,014. Net current assets should be negative value 80,754. If you add up the application B and E, that should be equivalent to this value. That should be equivalent to this value. Hope you will be now able to understand the preparation of the final accounts of life insurance company. In case of general insurance company, marine, fire and others, I just show the schedule only. I'm not going to solve the illustration here. You can try to understand that illustration yourself. So premium schedule 1, claims paid schedule number 2, commission paid schedule number 3, operating expenses schedule number 4. Find out the full value here. Okay. With that, you have to add unexpected risk reserve opening, subtract unexpected risk reserve closing. Closing unexpected risk reserve should be calculated at the rate of 50% or 100% on the net premium. Final value will be your surplus. Final value will be your surplus. This is how the revenue account is prepared in case of general insurance corporation. It's very simple. Not only that, you need to prepare the profit and loss account also. First set you write income, second set you write expenses. What is the income? All the three will be your income. What are the expenses we have? Those expenses seems to be common for all the three insurances. We cannot classify. Okay, probably they may invest somewhere. For that, if they receive the dividend not related to marine, fire and others will be posted in the income side of the P&L for first statement. Further, if you spend any expenses will be posted in the second half. Ultimate profit is transferable. The balance sheet is the same. Balance sheet is the same. Is that okay? Come on. You finish up copying this. And this GAC statement, no, this revenue account as well as P&L account. Just refer Singar Academy's one illustration, only one illustration I've given. Just go and see that. If you are able to guess where it may be posted, that's more than enough. No need to work out this separately. With that, this topic is completely over. Okay. Insurance company accounts is completely over.